Benjamin Cowen is warning that crypto confidence can weaken when policy signals become harder to model. His point is uncomfortable. A known regulator can be easier for markets to price than a leadership vacuum or a sudden Fed tone shift. Benjamin Cowen is the hook because the confirmed event creates a specific pressure point. Cowen frames Gary Gensler's SEC exit and Jerome Powell's future messaging as sentiment risks rather than direct proof of a new rule. The measurable anchor is sentiment risk, and the story turns on trust shock rather than broad hype. Instead of treating the headline as a market mood swing, this segment follows the mechanism that makes the change matter and the next signal that can prove whether the story is moving forward. The confirmed baseline is this. The framework treats trust as investor confidence in predictable U.S. policy, not trust in blockchain technology itself. That detail gives viewers the frame for the rest of the story. It shows what is already known, which actors or assets are involved, and why the event is not just a random market headline. For this story, Benjamin Cowen and crypto sentiment sit inside a process where policy vacuum can change the readout. The baseline also defines the boundary. Sentiment risk is usable evidence, while anything beyond policy vacuum still needs follow-through. The important part is to keep the evidence tight before moving into what the change actually does. Most people arrive after the move is obvious and the easy upside is gone. We focus on serious crypto education and high-quality signals before the crowd rushes in, so you can understand the setup earlier and move sooner. If you want that edge, visit the link below now. The mechanism is where Benjamin Cowen becomes useful. Crypto trades like a risk asset when liquidity expectations change, so Fed language can move sentiment even without crypto-specific action. In plain English, the event matters because it changes the way access, risk, settlement, liquidity, governance, or infrastructure works. In this case, the stress point is Fed signals, which is why sentiment risk is a signal rather than decoration. That is why the segment spends time on Fed signals before discussing impact. Without that mechanism, the event is easy to misread. The headline may grab attention, but the mechanism explains why traders, builders, users, or institutions have to care about the next step. The impact lands with a specific group, not with crypto as a whole. Traders, exchanges, and token projects are affected because abrupt policy uncertainty can reduce risk appetite across the market. That is the practical consequence. It may affect how users move funds, how institutions manage compliance, how traders price liquidity, how developers build, or how risk desks read the market. The affected side is tied to crypto sentiment and Benjamin Cowen, so the scope stays limited to what the supplied facts support. That narrower read is more useful than a sweeping market claim. The open question is just as important as the confirmed fact. Cowen's warning is one analyst framework, not a confirmed market outcome or consensus forecast. That means the story should not be read as a guaranteed outcome. The proof standard is simple. The next signal is Fed meeting language and early policy direction from SEC leadership after the transition. Until that signal appears, the confirmed development and the unresolved part should stay separate. A stronger claim would need Benjamin Cowen or relevant market participants to show follow-through around policy vacuum, not only reaction around crypto sentiment. That prevents a useful news signal from turning into speculation. Most people arrive after the move is obvious and the easy upside is gone. We focus on serious crypto education and high-quality signals before the crowd rushes in, so you can understand the setup earlier and move sooner. If you want that edge, visit the link below now. The next signal for Benjamin Cowen is concrete. The next signal is Fed meeting language and early policy direction from SEC leadership after the transition. If that signal appears, the story has new evidence. If it does not, the headline may remain smaller than the early reaction suggests. A clean follow-through would connect sentiment risk to visible action, usage, compliance, liquidity, or technical progress. For viewers, the usable close is not a direction call. It is a checklist tied to sentiment risk, trust shock, and the specific trigger above. The final readout is practical. Track the next verifiable step, not the loudest claim around the asset, rule, protocol, or market move.